Welcome back to the channel. Thank you for tuning in. Um, Before we begin, please take a moment to like and subscribe to the channel if you haven't already done so. Today's video is I'm gonna be reviewing this piece of price action that I have here. Obviously, before I begin, I'd like to show you the raw chart so that you can see what you're dealing with, and then I'll put the lipstick. So I'm gonna be analyzing from um this last candle day going back. So I'm gonna just be telling you what price did and whatnot, so that you may also take advantage of such moves. So obviously, to begin with, I'd like to take your attention to the original consolidation. But before original consolidation, can you also take note that original consolidation, it starts consolidating there while attacking this low. Can you see that? So it attacks this low using an original consolidation. Even the original consolidation, it begins immediately after they take out this low. And then price obviously consolidates inside this favorable gap. But overall, can you see that what I'm trying to draw your attention to, or what I'm trying to show you, or what I'm trying to have you take into account is that there's an original consolidation. In other words, there's an accumulation stage that is happening after liquidity has been taken out, right? Then obviously you can see that inside the original consolidation, there's a low that gets formed there, equal lows. Price traced through the equal lows. Another short-term low there being formed, price takes that. So as you can see, I'm trying to show you that is liquidity. So there's a lot of orders resting below that low there. Sell side liquidity. Price will trade through the sell side liquidity, engage with the short stops, so that the counterparty, smart money, when retail is selling that on a breakout, when the breakout artist is selling that, the counterparty, smart money traders, are buying that. There's a swing high there that gets taken out. There's a favorable gap there. Price trades to the old favorable gap and then runs away. It leaves original consolidation here. Using this candle specifically. How do I know it left? You look at the bodies. So as soon as it leaves, it prints a body outside original consolidation. When it returns, that's a return to original consolidation. But what price is actually doing is that price is trading to this opening price of this bullish order block there. Price trades to it there for a return to original consolidation, right? Then you can see price targeting what? Obviously, when price was going lower here, was moving lower, the traders that were selling this, they would put their stop loss above equal highs. So they'll see these equal highs and they'll see that as strong resistance. So smart money will target those equal highs because there's orders resting above those equal highs. Buy side, buy stops. In other words, buy side liquidity. So you can see price trading above equal highs there. There's a short-term low there that he has traded through also. So after they take out buy side liquidity, if they ever want to push it higher again, what they'll do is that they'll have to engage with sell side liquidity first. So before they push it higher, before the algorithm prices higher, it will first allow smart money traders to enter the market by fooling retailers into thinking that's a break of structure, while smart money actually buys those lows. while smart money buys the consequent encouragement of this week. Can you see that? What is actually happening is that we broke above original consolidation, we return to original consolidation. So this is the original consolidation. So you can see I used original. I used. So this is a return to original consolidation, guys. This is a return to original consolidation. So you can see here I used a breaking above, and then coming back on a candle basis. And then now I'm using breaking above and coming back on a more market structure basis, right? So that's my official return to original consolidation for the market maker buy model. We have a CBD and a BC. So this little segment of price action between, let me just zoom in. So this little segment of price action between the low of this candle and the high of this candle, that's my balanced price range. So inside my balanced price range, there's a fair value gap. Obviously, price trades above this high, swing high there. After liquidity has been taken out below this low, does it do it with displacement? Does it do it with magnitude? Does it leave a fair value gap? Yes, it does. So we trace with the fair value gap. But look, only the bodies are staying above the fair value gap. Only the wicks trade inside the fair value gap. The bodies are staying above because it's showing you that price is very bullish. It wants to go higher, and obviously it's not gonna close. It's not gonna completely fill this little segment of price action because that is a balanced price range, right? So it immediately runs away from that. Fair value gap there, find support inside the fair value gap. It does use the wicks to trade to this bullish order block, the opening price of this candle. That's a bullish order block. It trades to it there, and then it moves higher. Trade rise pattern. That is a good signature in price for a what? For a smart money reversal bearish. In my last video I mentioned that so I'd use the smart money reversal as separation between buy side and sell side price delivery. I don't know, this is not coming on. Okay, anyway. So after smart money reversal, we are now bearish. Swing low there, trades below the swing low. Can you see that? So when that happens, after we took out buy side liquidity above this equal highs, that's a market structure shift. So it trades through the swing low, leaves a fair value gap, and then comes back to it, to find what resistance inside the fair value gap. From the swing high there to the swing low there, price finds support at the 62. So can you see that? So that's a retracement level 62. What does it do after that? It breaks lower. Where is it targeting? Obviously, when it was going up, the traders that were buying this, they'll be very confident putting the stop losses below these lows here, below lows. That is sell side liquidity. So the algorithm will what? Target that sell side liquidity, target both sell stops from everyone who was trying to buy this when it was going up, for a full what? Market maker buy and sell model. Sell side liquidity gets engaged there. So I try to indicate that that is what? That's a stop rate. That is a stop rate. Obviously, sell side liquidity gets engaged, swing high there, it gets taken out using a fair value gap. Does price come back to find support inside the fair value gap? Of course it does. You can see price finds support inside this fair value gap even today. Before price reversed, Above this high, there was buy side liquidity above this, resting above. So when price was trading against targeting those sell stops, it left buy side liquidity. So after engaging with those sell stops, they will now target what? Buy side liquidity. So after engaging with sell side liquidity, they will target buy side. After engaging with buy side liquidity, they'll target to sell side, or maybe more buy side. So it just keeps on doing that, you know, indefinitely. The only two things that move price will only go up to take out buy side liquidity, or it will only go up to fill an imbalance in price. In other words, fill a gap. Price will only go down to take out sell side liquidity below a previous low or previous lows, or it will only go down to fill an imbalance in price below price. Those are the only two reasons why the algorithm moves. Anything else, it's it's not it's just confusion, right? It's just confusion. So buy side liquidity resting above this high there, it gets taken out there. What do they do? They induce, they create these equal highs. So what do they do? What do they do? They try convince retail that, you know, this is retail resistance, equal highs. This is strong resistance. So they create one, two highs, third high there, then they break above for what? For a stop rate. What do they do after that? They trade below price. So just like this was a stop rate, just like this was a stop rate, that's also a stop rate. So this was a stop rate against sell side liquidity. This was a stop rate against buy side liquidity, right? So after engaging buy side liquidity, they break below price, swing low there, it gets traded through here is the fair value gap in the displacement leg. So in other words, from the high there to the low now that took out this previous swing low, is the fair value gap? Yes, there is here. So price will trade to it and find what? Resistance inside the fair value gap, then break lower, targeting what? Targeting this imbalance. So it will only go, hence I said it will only go up to engage buy side liquidity, or it will only go down to fill an imbalance below price, right? After filling the imbalance, it creates a low there, retracement, and then takes out sell side liquidity below this low. After that, what do they do? They target buy side liquidity above this high. But now when you have a swing high there that gets taken out using a fair value gap, after sell side liquidity has been taken, that is a market structure shift. So the title of this video is gonna be Easy ICT Strategy on Purpose. Why? Is because this indeed is an easy ICT strategy whereby you wait for sell side liquidity to be taken out, swing high there, gets taken out using displacement. Displacement means magnitude, magnitude means fair value gap. Then you buy the fair value gap there. Target what? Buy side liquidity or fair value gap above price. So in this example, you'll target this old fair value gap there. Does it trade to it? Yes, it does. It might look like a small move to you, but it is not. I'm gonna show you right now why it's not, but I wanna put this here quickly to confirm a bullish market structure shift. So this is an this is an easy ICT strategy whereby sell side gets taken out, swing high gets taken out, fair value gap gets traded to, you buy the fair value gap. Target what? Buy side liquidity above previous highs, or target an imbalance above price. So in other words, or for this example, you target this old fair value gap, right? Trade to it there. Now, with that thinking, obviously everyone was trying to buy here, even you why are you gonna put your stop loss? You're gonna want to put your stop loss below this low, right? So now, after price trades to this imbalance, where is it targeting? It's targeting sell side liquidity. The reason I said from here to there might not seem like a big move to you, but actually, guys, actually we are on a daily chart, as you can see. So every candle here represent a daily candle. Every candle on this chart represents a daily candle. Obviously, the last candle day, that is Friday, 15th September candle. So the last candle, that is Friday, 15th September. So it's obviously we closed on Friday. Today is Sunday. The very first candle here, the very first candle here from the original consolidation, it's what? It's 9 November 2022. 9 November 2022. Okay, let me just zoom out there. 9 November from the original consolidation, that is 9 November 2022. And then where's 1 January 2023? 1 January 2023, it's here. After we what? We formed this low there and then we trade to it. We trade below it. 3 days later, we create this short-term low and then trade below it. Is it 9 days later? Then it rallies up from the 13th of January up until partial liquidity gets engaged officially on this day, up until 7 March. So imagine being in this trade for 3 months, literally. And that is in line with what? With ICT culture theory. So whereby every 3 months you are trading this long explosive moves. That is crazy, guys. So you can see this whole price action. That is price action for Euro ZAR, for USD ZAR, the whole year, the whole of 2023. Obviously, even from November last year. So this video concludes my opinion on this whole rand manipulation thing, saga that is going on. Like apparently the big banks, South African banks, are manipulating the rand. Do you seriously think for a second that if indeed someone was manipulating this, do you think that indeed if the banks had access to this, do you really think everything would be so perfect? Do you really think there would be perfection in the markets? No. It's because these markets are not controlled by anyone. They are only controlled by algorithm. Yes, the people may control the algorithm, but the people who control the algorithm or who know anything more about it that we do, they're on their faces. Come on. They won't be trending working for some bank. No. The random manipulation saga is just a big it's bullshit. Obviously I'm trying to not say too much to get myself in trouble, but I think it's bullshit. There's no way these markets are manipulated by any bank. It's all algorithmically delivered. The fact that it's paired with the dollar, that means that this is correlated somehow to what? To DXY. Obviously, this one is an exotic, but yeah, guys. So that concludes my easy ICT strategy, which is the 2022 model. I showed you, like, it's everywhere. It's everywhere on this chart. And also this, I just wanted to slip this in at the end. It's bullshit, this thing. There is no way anyone is manipulating this. They're just trying to find a way to, I don't know. There's things they're doing, but they're not telling us. They're telling us bullshit. But obviously, you don't care.